Welcome back to Boni's Life, your ultimate intellectual pit stop for decoding the financial matrix. I'm Boni, and today we're slicing through the noise of the crypto markets from July 1st to the 3rd and mapping out the geopolitical minefield for the next 3 days. Let's talk about the past 72 hours, a roller coaster that would make even the most hardened degen reach for the antacids. We kicked off July with Bitcoin plunging below $58,000, driven by the hawkish echoes of the new Fed chair, Kevin Warsh, who made it crystal clear that the interest rate dial is stuck at 3.5 to 3.75%, with half the officials eyeing a hike before 2026 ends. But just when the bears started planning their victory lap, the market flipped the script. A softer than expected U.S. jobs report, only 57,000 jobs added against the 115,000 forecast, injected pure hopium into the veins of risk assets. By July 3rd, Bitcoin had clawed its way back to $62,600, dragging Ethereum up to $1,730 and Solana to $77. The real kicker? Whales have quietly vacuumed up $16.7 billion worth of Bitcoin while retail panicked, and U.S. spot ETFs suddenly snapped a brutal 10-day outflow streak with a massive $221 million injection on July the 2nd. If you had dropped to $100 into the spot market at the absolute bottom on Monday, your Bitcoin would be sitting at $107.40, Ethereum at $108.25, and Solana at $104.50. Not exactly retire on a yacht money, but in a market gripped by a fear and greed index of 15, which is basically hide under the bed territory. That's a solid win. Now, let's look at the board for the next 3 days, July 4th through the 6th, because the geopolitical chess match is about to get intense. We are heading into a weekend sandwiched between the U.S. Independence Day liquidity drought and the highly anticipated NATO summit kicking off in Ankara on the 7th. With President Trump making his first visit to Turkey since 2015, the defense spending debates and potential F-35 fighter jet negotiations are going to cast a long shadow over global risk sentiment. Add to that the simmering undercurrents of the Section 122 trade tariffs and ongoing supply chain realignments, and you have a recipe for macroeconomic turbulence. The institutional money is watching this closely. While Standard Chartered is still stubbornly pointing to $100,000 Bitcoin by year-end, Citi has aggressively slashed their target to $82,000, citing weak ETF demand and institutional hesitation. This divergence means the smart money is hedging, preparing for a potential squeeze if the macro narrative shifts. You need to understand that the current recovery is heavily reliant on short covering rather than a structural shift in demand. The market is currently breathing a sigh of relief because the jobs data gave the Fed a reason to pause, but the underlying tension remains. So, how do we play this? Let's talk technical triggers and probabilities for the upcoming week. The line in the sand for Bitcoin is the 200-week moving average, currently hovering around the $59,000 to $61,000 zone. As long as we hold above $60,000, the bulls have a fighting chance. Scenario A, which I give a 45% probability, is the relief continuation. If ETF inflows persist into next week and the geopolitical noise from the NATO summit remains contained, we could see Bitcoin push toward the $64,000 to $66,000 resistance block. In this scenario, your trigger to enter long spot positions or low leverage futures is a confirmed daily close above 63,000 with strong volume. Scenario B, sitting at a 35% probability, is the chop and grind. We bounce between 58,000 and 62,000 as the market digests the upcoming FOMC minutes on the 8th. Here, range trading is your friend. Buy the support at 58,500 and sell the resistance at 62,000. Finally, scenario C, the hawkish washout, holds a 20% probability. If the FOMC minutes reveal a deeply entrenched desire to hike rates and the NATO summit sparks a broader risk-off event, Bitcoin could easily slice through the $57,900 support, opening the trapdoor down to the realized price zone of $53,800. If that $57,900 level breaks, cut your longs and prepare to deploy capital at the lower bounds. What sets this analysis apart is understanding the hidden mechanics of this market, the stuff the mainstream financial press glosses over. The retail narrative is obsessed with the daily price wiggles, but the real story is in the on-chain data and the institutional plumbing. Over the past 2 weeks, long-term holder supply increased by over 356,000 BTC, while short-term supply dropped by 343,000. This is a classic wealth transfer from the impatient to the convicted. The extreme fear sentiment is a psychological smokescreen. The whales are buying the blood while the tourists are selling the dip. Furthermore, the divergence between the Fed's dot plot, which projects a 3.8% rate, and the market's expectation of easing is a massive fault line. The market is calling the Fed's bluff, betting that a cooling labor market will force their hand. But if inflation proves sticky and the Fed holds firm, the resulting liquidity shock will hammer risk assets. You have to trade the reality, not the hopium. Watch the ETF flows on Monday. If we see a return to the heavy outflows of June, that July the 2nd injection was just a dead cat bounce. To wrap this up, the next few days are about capital preservation and strategic positioning. Don't get caught over-leveraged in a low-liquidity holiday weekend. Let the tourists gamble on the noise while you wait for the structural triggers to fire. Keep your eyes on that $60,000 support level for Bitcoin. Watch the institutional commentary surrounding the NATO summit and be ready to pivot if the macro winds change direction. The crypto market is a brutal teacher. But for those who understand the underlying mechanics of geopolitics, on-chain flows, and institutional psychology, it is the greatest wealth generation engine of our time. Stay sharp, stay disciplined, and remember that in this game, patience pays more than panic. I'm Boni, and this has been your Boni's Life Deep Dive. You'll see you in the trenches.